things happened in financial markets overnight that, on their own, would each be significant. Together, they may be signaling something larger. Goldman Sachs has quietly removed its forecast for any Federal Reserve rate cuts in 2026, citing a labor market that is simply too strong to justify easing. At almost exactly the same moment, Brent crude oil surged 3.63% to $96.75 a barrel, with West Texas Intermediate close behind at $93.89, driven by the overnight Iran-Israel strike exchange. And according to Fortune magazine, Barclays research has identified that the 10-year Treasury yield at its current level of 4.54% is in what they are specifically calling the warning zone, a corridor approaching the 5% threshold that analysts have flagged as a potential breaking point for equity valuations. These three forces have never hit simultaneously during this rally. Tonight, we explain what it means. Here is what we are covering today. We walk through exactly what Goldman Sachs said and why a stronger than expected labor market is the reason rate cuts are off the table for 2026. We explain what the 10-year yield warning zone actually means for your portfolio and the specific number that Barclays says would change everything. We cover the oil price spike and the direct link to the Iran-Israel conflict. We look at what central banks globally are signaling by hoarding gold at levels not seen since the start of this century. And we close with the question every investor is asking: is the stock rally that has seemed unstoppable finally running out of runway? Let us go through the events in order. The week began with the Federal Reserve releasing April consumer credit data on June 5. Revolving credit, the category that includes credit cards, rose at a 10.4% seasonally adjusted annual rate, while non-revolving credit grew 2.9% and total consumer credit expanded 4.8%. Those numbers, which at Federal Reserve posted directly, paint a picture of American consumers still spending aggressively on credit, a data point that supports the economy too strong for cuts narrative that would emerge 2 days later. Then, on June 7, market conditions began converging. According to Fortune magazine, Barclays published research identifying the 10-year Treasury yields approach to 5% as a specific danger level for markets. At 4.54%, their language was precise: we are in the warning zone, but just in the warning zone. The distinction matters. They are not saying the threshold has been breached, but that the margin is shrinking. Fortune magazine also reported broader analyst concern that multiple risks had suddenly converged to test what looked like an unstoppable stock rally, the kind of framing that historically precedes sharp corrections. Overnight into June 8, 2 more data points dropped simultaneously. According to Cointelegraph's reporting, Goldman Sachs officially removed its expectation for Federal Reserve rate cuts in 2026, citing a stronger than expected labor market. This is not a minor revision, it represents a fundamental shift in the rate trajectory that equity valuations have been pricing in. And at the same time, AJ English reported that Brent crude had already risen 3.63% to $96.75 in direct response to Israel's strikes on Iran, with WTI following at $93.89. For context, Cointelegraph also reported that global central bank gold holdings have reached their highest level this century, a signal that institutional actors, at the sovereign level, are building defensive reserves against exactly the kind of multi-shock environment now unfolding. The first question many investors are asking is, why does Goldman's removal of the rate cut forecast matter so much, and is a stronger labor market really a bad thing for markets? The short answer is that it depends entirely on the mechanism. A strong labor market is good news for workers and consumer spending, and the Treasury data published this week by SEC Scott Bessent cited 313,000 net new private sector jobs in 2 months, plus 17% annualized capex growth. But a labor market strong enough to keep the Fed on hold forces a repricing of assets that have been valued on the assumption of eventual monetary easing. If the discount rate stays high, the present value of future earnings, particularly in high multiple growth stocks, falls. That is not a recession signal. It is a valuation reset signal, which can still be painful for portfolios built on rate cut assumptions. A second critical question is what the oil spike to $96 means for the inflation outlook that underpins the entire rate debate. On that front, the timing is deeply inconvenient. An oil shock of this magnitude, driven by geopolitical escalation rather than demand, hits consumers through fuel and energy prices while simultaneously putting upward pressure on CPI, which gives the Fed even less room to consider cuts. According to the IMF's data published this week, the global economy now uses roughly half as much energy per dollar of output as it did in 1980, meaning oil shocks are less severe than they once were, acting as a cushion. But at $96 per barrel, with Barclays already flagging bond yields in the warning zone, the combination of a geopolitical oil shock and a hawkish Fed creates a stagflation-adjacent risk that markets have not had to price since the 2022 cycle. Some analysts suggest the convergence of these three factors: no rate cuts, rising oil, rising yields is precisely the stress test that determines whether the current equity rally was built on solid earnings or on the assumption of perpetual monetary support. Why does Goldman's removal of the rate cut forecast matter so much, and isn't a strong labor market actually good news? A strong labor market is genuinely good for workers, but it forces the Fed to hold rates higher for longer, which reprices assets built on rate cut assumptions. High multiple growth stocks are particularly exposed because their valuations depend heavily on lower discount rates. This is not necessarily a recession signal, but it may be a valuation reset signal. Some analysts suggest the market has been priced for a soft landing with cuts. A soft landing without cuts is a different and more complicated scenario. Does an oil spike to $96 revive inflation risk and make the Fed's no-cut stance even more entrenched? An oil shock driven by geopolitical escalation adds a cost-push inflation component that gives the Fed less room to maneuver even if the labor market cools. The IMF's energy intensity data suggests the global economy absorbs oil shocks better than in 1973 or 1979, but at $96 Brent with yields already in Barclays' warning zone, some analysts suggest the combination recreates a stagflation-adjacent risk profile that markets have not priced since 2022. In the United States, the most immediate impact falls on anyone holding a mortgage, a car loan, or carrying credit card debt. With Goldman Sachs no longer expecting Fed rate cuts this year, the high-rate environment that has squeezed household balance sheets since 2022 extends further into 2026. The Federal Reserve's own April data showed revolving credit growing at 10.4%. Annualized. Americans are still leaning on credit cards to sustain spending. If rates stay high and oil prices add to inflationary pressure, that credit dependence becomes more expensive, not less. For equity investors, the Yahoo Finance framing this week was pointed. Today's stock market leaders are hot but not 1999 hot. That comparison is doing work. The market is elevated but not yet in classic bubble territory, which means there is room to fall without requiring a catastrophic collapse. For Europe, the oil spike to $96 arrives as the continent is already managing an energy crisis that predates the Iran-Israel conflict. European households and businesses are more directly exposed to Brent crude pricing than U.S. consumers, and any sustained move toward $100 per barrel reignites the energy cost crisis that drove inflation across the Eurozone in 2022 and 2023. The European Central Bank, which has been more cautious than the Fed in its easing cycle, faces renewed pressure to hold rates higher as inflation risk re-emerges from the oil channel. For emerging markets and energy-importing nations India, Japan, South Korea, and much of Southeast Asia, an oil shock at this level is a direct balance of payments stress. These economies import the majority of their energy requirements, and a sustained move above $95 per barrel compounds the dollar-denominated debt service costs already elevated by the higher-for-longer U.S. rate environment. The IMF's data noting that global energy intensity is half of what it was in 1980 provides some cushion, but for the most import-dependent economies, the margin is thin. For oil-exporting nations Saudi Arabia, the Gulf states, Russia, and others in the OPEC Plus coalition, $96 Brent is a windfall that partially offsets the economic costs of conflict-adjacent uncertainty. Their recent OPEC Plus production adjustment, coordinated just this week according to the dataset, may have been designed in anticipation of exactly this price dynamic. A fair presentation of this story requires acknowledging the counterarguments, and there are meaningful ones. The strongest case against the bearish reading is that the U.S. economy is, by conventional measures, in genuinely good shape. U.S. Treasury's own data cited this week shows a $370 billion reduction in the goods trade deficit over 12 months, 313,000 new private sector jobs in 2 months, 17% annualized capex growth, and trillions in domestic corporate investment commitments. These are not fabricated numbers, they represent real economic activity that supports that no cuts needed because the economy doesn't need them interpretation rather than that no cuts because we're trapped interpretation. Additionally, on the oil and equity side, at Yahoo Finance noted this week that today's stock market leaders are hot but not 1999 hot, a meaningful hedge against the bubble narrative. and Nvidia CEO Jensen Huang, according to Cointelegraph, brushed off the chip stock sell-off by saying everyone should be excited they can now buy at cheaper prices. That kind of market confidence from a CEO whose company sits at the center of the AI investment supercycle may not be unfounded. The IMF's data showing global energy intensity at half its 1980 level is also a genuine structural buffer. The risk is real, but so is the resilience. Here is the detail that should stay with you. The Fortune tweet framing this week was not that markets are in crisis. It was that multiple risks have suddenly converged to test what looked like an unstoppable stock rally. The word test is doing a lot of work. Tests have outcomes. And the same dataset that shows Goldman pulling its rate cut also shows central banks globally loading up on gold at levels not seen since before the 2008 financial crisis. Central banks do not buy gold because they are optimistic. Pay attention to what the people who manage national balance sheets are actually doing with their reserves. Drop your answer in the comments right now. Do you think Goldman removing the rate cut forecast is a signal to get defensive, or is the economy strong enough that this is just a recalibration, not a warning? This debate is happening in every trading desk and family financial conversation right now. Tell us your read below, and subscribe so you catch the next market update the moment it breaks.